Hello, I'm Anastasia Amoroso, and this is Beyond 60/40. On this show, we do a deep dive into the alternative investment space and speak with industry leaders who share their insights and expertise on market trends, the macro environment, and investment opportunities. We start the show, as always, with my Market Pulse snapshot, and I'll share the one thing that caught my attention this week in private markets. Next, Bridgewater Associates Senior Portfolio Strategist Patrick Dimick joins me at the desk to talk about global macro investment strategy and how Bridgewater is approaching success throughout various market cycles. Then I sit down with iCapital's newly named Chief Product Officer, Jason Broder, who tells us about the game-changing portfolio analytics tool, Architect. And finally, I'll walk through the benefits of growth equity investing. Let's get to it. In today's Market Pulse snapshot, the one thing I'm focused on is artificial intelligence. With its ability to transform processes, enhance productivity, and meet the ever-evolving consumer and business needs, AI is definitely one of the most far-reaching commercial and investment opportunities today. AI is expected to add between 17 to 25 trillion in global economic value. But with everyone seemingly in agreement on its massive potential and the outperformance of AI beneficiary stocks, we have to ask the question, is artificial intelligence full potential already been fully priced in? Well, despite this outperformance, we believe the full multi-year potential of AI is yet to be fully priced into the beneficiary stocks. And here are some reasons. First, the rush to adopt artificial intelligence is driving a sizable increase in projected industry revenues. For example, in the near term, global AI beneficiary total addressable market, or TAM, is forecasted to double from $450 billion in revenues in 2022 to $900 billion in 2026, meaning it's growing at a CAGR of 18% over that time period. And the three major IT sectors that are benefiting from that are hardware, software, and services. But second, looking under the hood of beneficiary company estimates, what stands out is that despite massive potential growth projections, earnings estimate revisions for AI-related stocks have been fairly modest. Of course, that's with the notable exception of NVIDIA. Its EPS estimates have been revised by 77%, 95%, and 97% respectively for 2023, 2024, and 2025 years. But the median AI-exposed stocks saw a modest 1 to 3 year revision for those time periods respectively. And so the reason for those modest revisions, in our view, is that companies tend to issue revenue or earnings guidance that is relatively short-term. And that's what analysts tend to price into the models. But once companies guide higher, analysts include those in their higher estimates. So we believe the multi-quarter, multi-year upwards revision cycles to current earnings estimates is likely. This means current forward PE ratios may fall as earnings likely move higher. And by the way, adjusting for the 5-year earnings growth projections, the price to earnings to growth ratio, a PEG ratio, stands at 1.7 for the median AI exposed stock. So stocks are not as expensive as they might seem. Now, in addition to the public market, we see significant opportunities to gain exposure to AI through the private market. As we highlighted in the previous Market Pulse episodes, while the AI story has taken the public market by storm just this year, this has long been a theme in private markets, with venture capital funds backing and scaling AI companies for the last 10 years. As a result, there are 23,000 private AI companies globally today compared with 363 public AI companies. Bottom line, current analyst price targets seem to imply a floor but not a ceiling for AI stocks. As a result, we see this not yet fully priced in dynamic as an opportunity for long-term investors, an opportunity to buy the dips in AI-related companies and also consider private equity and venture capital managers that are funding this next generation of AI growth. And so to sum it up, 2023 may be the year when artificial intelligence went mainstream, but there's still ample opportunity for long-term investors. And that's your one thing in private and public markets this week. Coming up next, Patrick Dimick of Bridgewater talks about macro investing strategy and shares his view on the current market cycle. My first guest is Patrick Dimick, Senior Portfolio Strategist at Bridgewater Associates, one of the largest hedge funds managing approximately $123 billion in assets. And of course, Bridgewater has been doing deep fundamental research focusing on the macro environment for nearly 50 years. Patrick, it's so great to see you. Thanks for joining me in the studio today.
Thanks for having me.
Well, Bridgewater, not only does it span, several decades, but to me, it's really one of the most iconic hedge funds. And, I say that because as I was getting started, in the financial services industry, of course, the first thing you read is Ray Dalio's Principles. And, of course, during the financial crisis, we were all reading, how does the economic machine work? You leverage the economy, you then have to deleverage the economy, and that has pretty significant ramifications for the economy and asset classes. So, again, just, truly a thought leader in how the economies work. You guys are at Bridgewater, but you've been there for 16 years and you've seen a lot of different market cycles. So in your words, what has been Bridgewater's kind of key to success throughout all these different market cycles?
I think one of the keys is certainly focus. Like in many ways, Bridgewater is a simple firm to understand. We've always believed there's only two ways to make money if you're going to kind of leave the safety of T-bills or cash, and that is build a rock solid long-term asset allocation that can deal with whatever environment comes along in a reasonable way, and then of course make good tactical bets or deviations along the way. We think that's all there is, and because that's all there is, that's all we do. We work really hard on constantly improving our asset allocation strategy and our alpha or tactical trading strategies, and we don't try to be a financial supermarket to have the product that is hot or fashionable in the moment. So maintain that focus. And then if I could add just a little bit more on the reasons for the success, I think whether you're doing asset allocation or tactical trading, also critical to our successes, start with deep fundamental understanding of how you think the market economic machine works, rather than doing statistical, quantitative, backwards optimization type of approaches. We're very systematic. It's really useful when you get that understanding after doing the research to write it down into a set of decision rules that you're going to follow, because then you never forget any lessons learned. And then the last thing is just diversify. Like even if you have deep fundamental understanding and it's like deployed in this very disciplined and systematic way, you can only get your odds of being right so high. Beating markets is hard. Got to spread out the bets. And I think it's some combination of those things that have led to whatever success Bridgewater has had.
Yeah, well, it's fascinating, and I love the point about truly understanding not just the correlations and assigning some statistical significance to it, but really understanding the core drivers of why things work the way they do, and then applying a rule book, applying a formula. And as I've been in the financial services industry, my very simple playbook has been you look at valuations, you look at positioning, and you try to identify a catalyst. Obviously very simplistic, but the point being is there's a set of rules and a formula that you look at Bridgewater. Well, you are one of the top macro managers out there, and let's talk about macro. The macro environment that we've been in 2022, and we're now in 2023. It probably couldn't be any more different, whether it's rates, inflation, growth concerns, tech valuations. It is all flipped in a span of about 6 months. So what's your big macro view right now on rates, recession or lack thereof, inflation? And I guess the question is, why do you think the macro environment has shifted so much so quickly?
I think in a nutshell, 2022 was the year of the tightening. We would argue it was a historically aggressive tightening by the central bank, not just an average tightening. And so the environment of 2022 is all financial assets have to reprice to remain competitive to cash. So that's kind of like the market impact of the tightening hits first and hits fast. And for sure, we all noticed that. 2023 now, you shift the debate in the markets to what will be the impact on the real economy from the tightening. We all know, what's that central banking phrase? Monetary policy works with long and variable lags. Indeed. Okay, what's going to be the outcome this time? So 2023 is all about the markets betting on shifting perceptions of answers to important questions like, will this tightening create a recession or won't it? And right now the markets are pretty firmly convinced that the tightening they did last year, that'll be enough to make the inflation problem completely go away, and we'll be able to avoid recession.
And that's the market view, right?
Yep.
But how do you answer the question about these long and variable lags? Are they still coming, or is the market right to say, well, maybe we don't have to worry about that anymore?
We're more in the still coming camp. We know that it takes typically, on average, 18 to 24 months for a big tightening to produce the bottom of the economic cycle. So we're probably halfway through that at this point. So yeah, we're more in the camp of it's probably coming, but it's been slow to come. And I don't mind telling you, we were a little too bearish on growth a little bit too early, for example. But when we look back at why that happened, I think the economic slowing has been slow to come, because in part of how much cash there was on private sector balance sheets from the response to COVID. Households, corporations had a lot of liquidity they could spend down, which with the benefit of hindsight, I think had a bigger effect on slowing the slowdown's arrival than maybe we would have predicted. But yeah, more in the camp of a tightening that big is going to have real effects that bite on the real economy. We think we can already see those cracks forming, and they were just a little bit slower to form this time for reasons that I think are understandable.
And maybe it's the 1.5 trillion of excess savings. That's the cushion that you were talking about that kind of prevented us from having a recession in 2023. But to just kind of put a fine point on that, do you think recession in 2024 is the base case? That's our base case. We think recession's more likely than not. It's certainly avoidable. For example, if the central banks decided they weren't going to worry so much about how low inflation goes and how long it takes to get it there, they could choose to reintroduce liquidity and more easing in order to avoid the recession. We don't think they'll probably do that, and that's part of the reason why our base case is for some sort of at least modest negative GDP by the middle of next year, by the middle of 2024, and then where we go from there, deeper or not, is totally up to the policymakers on what they do when they see that growth, and do they feel constrained or free to ease. Well, it all hinges on the outlook for inflation, of course, and we've sort of been, and I think I saw this from somewhere, the summer of disinflation has felt great for markets, and if you look at the economic forecast, they have inflation going sort of towards 2.4% at some point in 2024. Do you buy that? Do you think we get into the twos? And I guess the other question is, if we sort of flatline around 3%, do you think the Fed goes tighter, forces a recession to make sure we get to 2?
I'll take the first part first. We think the last mile of this disinflation back down to target is going to be the hardest mile. And what I'm referring to is, okay, inflation goes from peak of 8 or so down to 4 or 5 these days. And as you point out, markets are saying it'll continue lower. I think we know why the inflation fell as far as it did already. They're kind of the obvious candidates: commodity prices lower, housing market down, lots of supply chain problems getting fixed.
Food, fuel, all down.
All of that stuff points to inflation falling a lot. But again, that concept of the last mile, we think that takes a big unemployment rate cycle to get rid of the wage inflation to get to 2. So on your question, does Bridgewater think we'll be down at 2.5 in 12 months from now? We think probably not, because you need to break the back of the labor market first. Then you ask me kind of a much more interesting and harder question, which is, do you think the central bank will just kind of relax that whole goal of getting inflation down to 2? I think that's definitely possible if there's a lot of economic pain out there, high rates of unemployment, high rates of misery, and inflation isn't down completely to target yet. I could imagine them becoming a little bit more relaxed about whether there's really a problem with 3% inflation. What I don't think is going to happen is that they'll announce to us anytime soon, before there's economic pain, that they've shifted an inflation target, because there's no upside to doing that now. They don't have to.
Right. That's a really interesting perspective, that we sort of stagnate around 3%. The Fed is not just going to kind of be coerced by the market, to say, okay, we're happy with that. So it really requires economic pain, and the recession probably still comes first before the Fed may acquiesce to maybe pausing with inflation at 3%. That's a really fine point and a differentiated view. And speaking of other differentiated views, we got the economic environment, but let's talk about what do you do about it. And I know there's a lot of tactical trades that are constantly being implemented in the portfolio. One of them is about rates. How do you feel about rates, and where are rates headed in this environment?
Yeah, you're right about that. One of many tactical positions we're running right now is a pretty bearish view on developed world bonds, especially in the US. Now, part of that relates to some things we've just spoken about. The last mile of disinflation could be a lot harder to come by than the first couple of miles worth. That could constrain the Fed from delivering all those interest rate cuts that are now priced into the bond market for last year. So some typical, let's say, macro reasons for being short bonds. But I think we wouldn't be this bearish on bonds if there weren't also a big supply problem looming that I think is underappreciated. It's pretty amazing in the last year or so that the federal government could run a 5 to 7% of GDP budget deficit and issue very few bonds, issue very little duration into the market. And the way they pulled off that trick, run a big deficit but don't issue many bonds, is they just spent down their cash. And then when they did issue debt, issue lots of T-bills and not that many bonds. That's about to change. They've just announced that that's about to change. And I think that when we look at the lineup of prospective buyers of bonds and what kind of environments motivate them to buy bonds, there aren't going to be enough buyers to handle this sharply increased supply of Treasury bond issuance that's coming. Now I put that next to some of our economic views, and it's kind of like all the stars are lining up to a bearish bond bet, which, as you said, that's one of the bets that we really like in the portfolio right now.
With rates, by the way, going from 4% on a 10-year to, what do we think?
Oh, I wouldn't be surprised to see a 5 at some point in the next year, sure.
Yeah. Okay, well, now you got me really worried because, for years we've been getting a lot of questions about the U.S. budget deficit, and also things like, what if Bank of Japan, widens its interest, its yield curve control, and they have higher rates in Japan? What's the knock-on effect on U.S. Treasuries? So you put all that together, and that's why the view might actually be accurate that we might get to 5% raise. Okay, I'm worried now, but there's something else that I know you're worried about and people don't talk about. So tell us what that is.
Yeah, I think the big thing all investors should be thinking about, even if it doesn't turn out to be a next 12-month thing, which is certainly possible, is what do you have in your portfolio that can do well if GDP starts to turn down, to turn negative, but interest rates don't?
Right.
I don't know if we're going to find ourselves in the next year or two in that world where the economy is becoming very weak, the unemployment rate is going up, but the inflation rate's not low enough yet to allow the Fed to come riding to the rescue. It's probably been 40 years since we lived in a world where GDP went down, but interest rates didn't, because central banks were constrained. And that's a very dangerous sort of environment for traditional portfolios that, while it's never happened in our lifetimes, investing lifetimes, we know it can happen. And we think there's certainly enough risk that it does happen again, that it's worth combing through portfolios line item by line item and saying, what do I have that could work?
Right. Well, speaking of risks, just real quick as kind of the last thought here, one of the risks that you think investors should be thinking about is not having enough diversifying assets in their portfolio, and that means not having enough alternatives. So add a little bit more to that.
Yeah, I think where alternatives come in is very much through this sort of scenario analysis planning that we were just talking about. And I think if you use alternatives to obtain things like more exposure to inflation hedging assets in case that last mile of inflation does prove to be a problem down the road, or absolute return. I think within the world of alternatives, there certainly are managers and strategies that can be short as often as they're long, do a lot of relative value trading. And if you're truly unconstrained, I can be long or short or do spread trades and relative value trades. Those are all examples of strategies that have a good chance to still make money, even if we wind up in a much more difficult sort of economic environment.
Right. Patrick, thank you so much. This has been fantastic. You certainly gave us a few things to worry or at least ponder, whether it's constrained central banks, but you certainly give us, a lot of comfort knowing that there is a toolkit that is unconstrained, which relies on long trades, short trades, and also relative value trades. And all of those you look at all the time at Bridgewater. So we thank you so much for that and sharing your out of consensus opinions with us. Thanks so much.
Thanks. Love being here.
Thank you. Next up, iCapital Chief Product Officer Jason Broder joins me in the studio to talk about the analytics tool that is changing the game in the alt space. Welcome back to Beyond 60/40. Today, I'm excited to welcome iCapital Chief Product Officer and member of the Management Committee, Jason Broder, to the show.
Thanks for having me, Anastasia.
Well, it's great to be with you. And, prior to coming to iCapital, you were, of course, the CEO of Simon, which was acquired by iCapital last year. And prior to that, you spent, your career at Goldman Sachs. And I know that you've been involved in the world of equity derivatives and financial technology surrounding all of that, for a number of years. So especially in the last 10 years, as you thought about technology, financial technology, I know you've been thinking about the gaps that are out there and filling those gaps with technology solutions. So with that, we just recently launched a very exciting tool, Portfolio Architect, just a couple of weeks ago. And tell us, what is Architect? What does it do for portfolio construction? And how does it help advisors?
Great. Well, we're really excited about Architect. It is our new portfolio construction tool that helps financial advisors really understand where alternative investments and structured investments could fit in a portfolio and how it might help their client's portfolio better align with their client's investment objectives. So there's a lot of portfolio analytics tools that are in the market, probably 50 plus, all of them very good. But none of them really consume and analyze alternative investments or structured investments, let alone both. And so the real powerful part of Architect is being able to look at all vanilla assets together in the same portfolio with alternative investments like private equity, private credit, hedge funds, and structured notes. And it's something that financial advisors have been asking for years and years. And our view is that Architect will really help them adopt alternative investments and really become more mainstream as opposed to niche where they are now.
Right, and having this comprehensive picture of how it all fits together certainly helps a lot. And when you're able to go into the Architect, what kind of scenario analysis, what kind of modeling can you do exactly, relative to the classic 60/40?
So when you think about classic 60/40, in a lot of cases, you're looking at risk reward, which is great when you're looking at vanilla assets like ETFs, mutual funds, stocks, bonds. But when you're looking at more complex assets like alternative investments, like structured investments, you have to think about that in more than that one dimension. And so what Architect really does is it thinks about a portfolio across 5 dimensions: protection, upside, liquidity, simplicity, and underlier history. And what we do is we take every product and therefore every portfolio and we map that across 5 dimensions. So you can think of like a 5-sided pentagon. We do the same thing with the client's existing portfolio. So let's say it's a 60/40 portfolio. And what we do is we overlay the portfolio with the client's investment objectives, so his or her target across all 5 dimensions, and we measure the alignment. And the closer you get to 100, the better.
Right.
And so what the tool does is it looks at alternative investments and structured investments and sees how does that affect my portfolio across the 5 dimensions, and ultimately does it better align with my client's target profile.
Right. That's fantastic analysis to be able to do. And this tool has now been launched for about 2 weeks. It is in the hands of some financial advisors. So I'm curious, what has the feedback been like? What is the early stage kind of response to it?
The feedback's been great because, like I said, there's not other tools out there that can help advisors look at the data and analytics around alternative investments or structured investments. So for example, we can create a portfolio, let's say it's a 60/40 and we add 10% to alternative investments. We can look at that portfolio and we can see how it would have performed over time compared to the 60/40 portfolio, and actually compare what it outperformed, underperformed, and really look at that data going backwards. Now, that's not something, like I said, that exists in the market today. So when advisors are having conversations with clients, they need that data and those analytics to have informed discussions and therefore help the client make an informed decision.
Right. And so it's in the hands of some financial advisors today. The early reception has been great, which is fantastic. But just thinking longer term, how impactful do you think this tool, this portfolio construction tool, Architect, can be in helping advisors more fully embrace alternatives?
I think it can be very powerful. And I say that because what we've found is if advisors can learn about alternative investments and ultimately teach their client about alternative investments, clients generally get more comfortable. And that's when you see the pendulum swing from niche to more mainstream. We've seen that with many asset classes over the years. What Architect does is give financial advisors the tools that really empower them to have that confident story with clients, because they can point to the data and analytics from Architect to discuss if an alternative investment might help their client.
Right. It's interesting because it's sort of a new concept, right? We can actually visualize this and we can quantify this. And it seems like, for several years now, there's been, the sentiment that yes, we need to more fully embrace alternatives, but how much and, in what proportions and how much do I peel off from public equities to private equity and what does that do? So the fact that there's some tangible answers and some tangible visualizations that are quantifiable, that's certainly very, very powerful. So there are features that have been well accepted, so far. But what else is on the roadmap? What are some of the other features that advisors might be asking for?
It's been great because our roadmap's actually lining up nicely with what advisors are asking for now. Two particular features that I'll highlight. One is optimization. So today in Architect, you can import your 60/40 portfolio, and you can see how any potential alternative fund that I have access to, private equity fund, private credit, hedge fund, if you put it into the portfolio, how it impacts it. What the optimization tool will do is let the advisor to define the objectives and the constraints, and it will actually look for those funds that are on the menu and maximize the alignment score that I mentioned earlier. So that's big for advisors because it'll save them time.
Right.
The other piece is looking at projected income or yield. Obviously, you can do that today pretty easily in a 60/40 portfolio with public equities and bonds, but it's harder when you add alternative investments or structured investments to project what the income or yield will be. So we're in the midst of doing the quant research now before we incorporate that into the tool, but it's in our roadmap for end of year, early 24, and we're excited about it.
So taking the guesswork out of the equation, to me, that's what's on the roadmap, is not letting clients and advisors guess of, do I add a little bit of this or a little bit of that? But if there's a specific tangible client goal, here's what the likely allocation should be. And by the way, I think that lines up very well with how advisors ultimately manage portfolio assets for their clients. It's not about a Sharpe ratio, it's not about a certain, equity derivative outcome. It's about, how do I create a certain level of income? How do I create a certain level of risk tolerance while achieving sort of a required level of return? So this is a goals-based approach that sounds like very much on the roadmap for Architect. And, Jason, the last question, just kind of zooming out and thinking about the broader adoption for alternatives, what else do you think it takes, for advisors, for clients to get comfortable with allocating more and more to alternatives?
Yeah, so right now we look at the 60/40 portfolio as 60/40, and do I add alts to that? And what we're trying to do and trying to really help advisors communicate to their end investors is that it doesn't have to be 60/40 plus alts. Yeah. 60/40 can combine both public equities and private funds as well. And by thinking about it that way and thinking about, okay, I don't need to be 100% liquid, I can be 10% illiquid. And reshaping the conversation, again, what we're trying to do is help advisors discuss why alternative investments should be part of the core portfolio, not part of the satellite. And we do that by helping them think about that in the context of the 60/40 portfolio, even if the 60/40 today is public, but tomorrow it's 60/40 with a lot of public and a little private.
Right. And of course, there's a lot of data to back that up. Why alternatives, maybe were kind of thought as a nice to have, but now they are going mainstream. It is a need to have for client portfolios. Well, Jason, thank you so much for coming by, and it's been fantastic to catch up with you. We're very excited about the launch of Architect and look forward to sharing that with more and more advisors, and certainly we'll look out for those new features. But congrats.
Thank you.
Coming up next, I'll explain the fundamentals of growth equity investing. Welcome back. Here on Beyond 60/40, we not only keep you up to date on private markets, but we also help investors build a foundational understanding of the investing landscape and the alternative investment space. With new financial technology platforms making it possible for high net worth individuals to access private market investments, investor education is more important than ever. Today, we're covering growth equity investing and why its unique risk-return profile can make it an attractive addition to a well-diversified portfolio. Growth equity is an investment strategy that sits between venture capital and traditional leveraged buyout strategies. Managers pursuing the strategy target companies in the development scale-up stage with proven business models and significant revenue growth potential. Now, often these investments are underwritten based on a clear business plan with defined profitability milestones, as well as visibility on the next level of growth and quantifiable funding needs. Growth equity managers typically focus on private markets because the pool of attractive targets is substantially larger than those in public markets, and on industries that are exhibiting rapid expansion. These investments could be minority or majority stakes and typically use little to no debt, which can provide downside protection and flexibility during market downturns. For more information about growth equity investments, visit our Insights and Education page at iCapital.com. I'm Anastasia Amoroso, and thank you for joining us today. We'll see you next time on Beyond 60/40.